Hi, this is Mark Gordon with GoldenTicker.com, and today I wanted to show you how to spot a market bottom. And this is a technique that William O'Neill has used for many years, and of course he is the founder of Investors Business Daily and the author of a great investing book called How to Make Money in Stocks. And his technique for spotting market bottoms is based on what he calls a follow-through day. And in his research, no market rally has ever started without a follow-through day. So this becomes an invaluable tool for spotting a change in the market direction to the upside. I'm going to take you back to the start of the present bull market, which was back in March of 2009. And this here is a daily chart of the NASDAQ Composite. And you can see that we've been selling off for quite some time, and we reached a bottom here in March, around March 9th. And what we're looking for, first off, is an up day. And we had one here. Here's our first up day. This was March the 10th, and we had a 5% move in heavy volume. So this becomes day one of an attempted rally. Okay, so once we have day one, we're now looking for another up day of at least 1.7% in heavy volume, and it should have an explosive feel to it. So on day two here, we only had a 0.4% increase, and the volume was just about average, so that doesn't count. But here on day three, we had an up day of 4.3% in heavy volume, which qualifies as a follow-through day, except for one thing. It happened a little too quickly. You want to see the follow-through day happen within 4 to 7 days of the first day of an attempted rally, ideally. So this one doesn't count. And day 4, we had a tiny gain here in light trade. And day 5 was a down day. That doesn't count. And day 6, now we had an up day of 3.8%, which is well above our 1.7% minimum. But if we look down here, the volume was weak, and so that doesn't count there. And our follow-through day did come here on day 7 when the NASDAQ Composite was up 2.4% in heavy volume. And this does have an explosive feel to it. It got right here above the 50-day moving average and closed above it. So this is your follow-through day on March 17th. Now what a follow-through day does is tells us that large institutional buyers are stepping into the market and supporting stocks to move up. What it doesn't tell us is which stocks to buy and how high up it's going to go, of course. Okay, now that you have your follow-through day, you're also going to need to have sound institutional quality leaders that are setting up in bases and getting ready to break out. Taking a look at Apple Computer here, we can see that it's set up in a base here in late 2008 and started to break out here right along with the general market. And another stock with great earnings and sales records was Green Mountain Coffee, which set up and broke out along with the general market as well. And another monster stock that was confirming the follow-through day and the change of the market was Priceline.com, which had already been on a very aggressive up move before the follow-through day, and had broken out here in mid-February, and then subsequently pulled back right around the early March area where we got our follow-through day. It found support here at the blue line, which is the 50-day moving average, and was rebounding off of that line, and it could have been bought there. So just to recap, a follow-through day is a day where the market is up 1.7% or greater on heavy volume, and that ideally occurs between 4 to 7 days after the first day of an attempted rally. And again, not all follow-through days lead to a new bull market, but no bull market has started without a follow-through day. And it's also important to make sure that leading stocks are setting up and or breaking out of sound bases before jumping back in the market.